Markets don't rise or fall randomly. They move like stories do, with tension, momentum, conflict, and resolution. And the investors who win over the long term aren't the ones who predict the next chapter perfectly. They're the ones who understand the pattern of the story itself. That idea sits at the heart of everything you're about to hear. As this presentation opens, the title isn't just naming two market phases. It's pointing to a deeper truth. Bull markets and bear markets are less about charts and more about behavior. They are mirrors. They reflect how humans respond to opportunity and fear. And once you see that clearly, investing stops feeling chaotic and starts feeling navigable. Here's what we're uncovering first. This session isn't about stock tips or timing tricks. It's about learning how market cycles work so you can make calmer, smarter decisions, whether prices are soaring or falling. Because the real edge in investing isn't information. It's emotional control paired with preparation. As we move into the overview, notice how simple the agenda really is. Definitions, emotions, strategies, transitions. That's intentional. Complexity doesn't build wealth. Clarity does. When you know what phase you're in and how people typically behave there, you stop reacting and start responding. Now let's ground this in reality. Markets move in cycles. They always have. Long before apps, charts, and headlines, markets rose and fell based on confidence, fear, and expectations about the future. Every investor, no matter how experienced, eventually faces moments of euphoria and moments of doubt. The difference between those who compound wealth and those who compound regret is preparation, not prediction. Preparation. This brings us to the core definitions. Slide 4 explores what we really mean when we say bull market and bear market. A bull market isn't just prices going up. It's a sustained rise, usually 20% or more from recent lows, powered by confidence, growth, and optimism. Businesses expand, hiring increases, innovation accelerates, people feel safe taking risks. A bear market is the opposite. Prices fall 20% or more from highs, confidence shrinks, spending slows, fear takes the wheel. And here's the key insight. These phases are not just economic events. They're emotional environments. They reflect how humans collectively feel about the future. Building on that idea, let's look at bull markets more closely. Bull markets feel good. They reward participation. Stocks rise, portfolios grow, and success feels inevitable. You'll notice strong earnings, low unemployment, and a constant stream of positive stories. New investors rush in. Risk feels invisible. But this is where discipline matters most. Because bull markets don't end when things are bad. They end when optimism becomes unquestioned, when caution disappears, when people stop asking what could go wrong. Opportunity grows fast, but discipline has to grow faster. History shows that most long-term losses don't happen in bear markets. They happen at the end of bull markets, when emotion replaces judgment. Shifting focus. Notice how different the emotional texture is in a bear market. Prices fall. Headlines turn negative. Fear spreads faster than facts. Layoffs increase. Spending contracts. Volatility spikes. And yet, this is where the seeds of the next bull market are planted. Bear markets punish emotional reactions. Panic selling locks in losses, but they reward preparation and patience. Quality assets go on sale. Strong businesses survive. Long-term investors quietly build positions while others flee. This is why experienced investors don't fear bear markets. They respect them. So what actually causes these shifts? This brings us to the triggers. Markets don't flip overnight without reason. Interest rates rise, inflation spikes, credit tightens, geopolitical shocks hit, bubbles form, and eventually burst. Technology changes entire industries, but underneath all of that is psychology. Extremes in confidence create extremes in valuation. When optimism or fear reaches its peak, the cycle turns. Understanding this doesn't mean you can time it perfectly. It means you're not surprised when it happens, and that awareness alone changes how you act. Now let's anchor this with history. Think about the bull market that followed the 2008 financial crisis. For over a decade, low interest rates and technology drove enormous gains. Companies like Apple, Amazon, and Microsoft reshaped the economy. Investors who stayed disciplined and invested consistently were rewarded. Then look at the crash itself. Excess leverage, overconfidence, complexity nobody fully understood. The lesson isn't that crashes are unpredictable. It's that excess always creates vulnerability, and recovery always follows, but only for those who stay in the game. This naturally brings us to strategy. During bull markets, the goal isn't to get rich fast, it's to participate wisely. Lean into equities, focus on growth sectors, use dollar cost averaging to avoid emotional decisions, and most importantly, rebalance. When something grows too large in your portfolio, trim it. That's not pessimism, that's discipline. Bull markets reward patience, but they punish greed. The investors who survive them are the ones who assume the cycle will eventually turn, because it always does. Now let's prepare for the tougher phase. In bear markets, strategy shifts from expansion to protection. Quality matters more than excitement. Cash becomes flexibility, not wasted opportunity. Defensive assets stabilize portfolios, and steady investing continues, even when it feels uncomfortable. This is where most people fail, not because they lack intelligence, but because fear overwhelms logic. Bear markets test your identity as an investor. Are you someone who reacts to emotion, or someone who follows a plan? The answer determines your long-term outcome. At this point, the core insight should be clear. Markets move in cycles, but your strategy shouldn't. That's the transition into the key takeaways. Emotion is the real enemy, not volatility, not uncertainty. Emotion. Preparation beats prediction every single time. Ask yourself, do you have a plan for both rising and falling markets? Or do you only feel confident when prices are going up? Awareness is the first step to improvement. This brings us to reflection. Take a moment to think about how you react when markets fall. Do you avoid looking? Do you panic? Or do you calmly assess? And in rising markets, do you chase excitement or do you stay grounded? Calm, disciplined investing isn't about removing emotion. It's about designing systems that protect you from your worst impulses. That's how professionals think. And it's a skill you can build starting today. As we close, here's the perspective to hold on to. Bull and bear markets are not threats. They are teachers. They reveal your habits, your assumptions, and your emotional triggers. Investors who endure, learn, and adapt don't just survive cycles. They compound through them. The actionable step is simple. Review your portfolio through the lens of cycles. Ask whether it can survive both optimism and fear. Set rules before emotions rise, and commit to consistency over cleverness. If you found value here, subscribe, hit the thumbs up, and turn on notifications so you don't miss future deep dives like this. And don't forget to download the PDF in the description. It's designed to help you apply these ideas immediately, not someday. Markets will continue to rise and fall. That's inevitable, but how you respond, that's your choice. Build the mindset now, and the cycle works for you instead of against you.